Hey, everybody, it's Helmer this week, coming with your mortgage market update. We have a guest this week. We have Tom Ahles. It's not that hard, Tom. See,
You hit it.
It's
Perfect.
easy, baby. It's easy. So thank you for joining us, Tom. How are you doing today, my man?
Man, I'm doing amazing. I've had started off the day on the right foot, got my workout out of the way. Starting to see a little bit of traction, but I'm in Minnesota, so this time of year, it's slower for normally slower, but still have some business going right now, which is a good thing.
Well, that's good. Yeah, it kind of gets quiet in the winter. So, Tom, go ahead and tell us a little bit about yourself. You said you're in Minnesota, and how long you've been in the business. Tell us a little bit more about you.
Yeah, absolutely. So I got into the industry in 2001. I have been, in mortgages basically the whole time. 2008 took a little small hiatus and went back. I used to be in the restaurant nightclub industry. Went back to that for a short period of time, and then came back to mortgages after a quick 8-month hiatus and moved all around. I've lived in, I was born in Florida, grew up in Ohio, lived in Knoxville, Nashville, Tennessee for a little bit, found myself in Minnesota since 2010. Originally, I lived here for a little bit before then, but have been here, started a co-founder here with Edge Home Finance. We're currently the second largest brokerage in the nation. And so I serve as executive vice president with Edge and co-founder. And then I'm also president of our National Trade Association on the growth vertical for AIM, which stands for the Association of Independent Mortgage Experts. And I've been a part of Vetted VA, I would say pretty much since the beginning of it, since Chris's vision of, making sure that veterans had a very good place to come and get information without being solicited, making sure that that information's truthful, making sure that it really is to serve our members than it is to serve us in the mortgage industry or real estate industry or whatever industry it is, so not pillaging the community. And I really liked it. I've stayed a part of this community the whole time. Primarily, I like the mission. I never served personally in the military. I tried. I'm blind in one eye. They wouldn't let me in. But everyone, as far as I can track back from my dad, my grandfather, my great-grandfather, have always served. So for me, it's been a great way to be able to, find a way that I can give back a little and try to be of service to those that have been of service to myself and my family.
Awesome. Well, thank you. So if you're here live, folks, go ahead and let us know you're here. Say your name in the comments so I know who you are. Be part of the conversation. Make sure you ask us any questions you have. Share any thoughts. If you are watching on the replay, I know many of you don't have the opportunity to make it live. That's okay. If you're here on the replay, give us a hashtag replay. Let us know that you are here. Also, we do monitor the post. So if you do have any questions, go ahead and ask them. We'll be monitoring them through the week until next week, and share any thoughts that you have as well. We'll be taking a look at that. So let's go ahead and let's talk rates, and we'll do our rate recap. Let's start off there. Remember, this is not an offer to lend. And when we talk rates, we're talking about averages and generalities. And one of the most important things that you can do is to go ahead and shop around. And actually, this last week was a great example of why you want to go ahead and stay aware of what's going on with rates and where things are at. So quick recap about what actually happened. Let's I'm gonna put us both on the screen and let's talk rates. So rates went from most of the country in the 7s. We actually dropped back down into the 6s. And Tom, are you an Aerosmith fan by chance?
A little bit. I mean, I think everybody, if I was right on the cusp, but somebody asked me this today, are you a Gen Xer or are you a millennial? I'm like, I was born in 1980, so I'm right on the line, right? I can identify with both, but everybody loves Aerosmith.
I was to say, I just saw Aerosmith in Vegas not too long ago, and Steven Tyler, 70-something years old, rocking out, and it was crazy. But I just get reminded of the song that Back in the Saddle again. It's back in the 6s again. So yes. Basically, many of you may have noticed that interest rates have gone down. If you did lock in a loan over the last couple of weeks, you definitely want to reach out to your mortgage professional. I don't like putting mortgage professionals in a rough spot. Many of them have probably already reached out to you if you're their client, but definitely reach out to them and find out if you do have any options and if you have any option to renegotiate or maybe take advantage of what's called a float down, because we've seen a very dramatic improvement to rates over the last week, much, much more so than I thought we were going to see. Many of you that join us each week, when we talk about this stuff, did not expect to see it. And the reason that we got it, let me set up the punchline, and I'm throwing Tom kind of in the spotlight here. But Tom, do you know why we saw rates drop last week the way that we did?
I do. Yeah. I mean, we came out with the October CPI report, right? The Fed did. And, for me, understanding what that CPI report really consists of, I'm always learning. So it's fun to be able to be on this, and I hope to learn as well here today. But I kind of, my wife, as I was explaining to her, I came home happy, right? I think the market went, we saw mortgage-backed securities, the yield jump up on them, which means the 10-year treasury went down. 10-year treasury is always a good way to get an idea where true market rates are without having to check a source, meaning like check a lender. 10-year treasury, is a good indicator that we saw the 10-year treasury drop almost, what was it, Hammer, 40 basis points, right?
Yeah, it went from over 4.25 down into.
Yeah, I mean, it was a lot. It went from 4.25 down to where today I think we're at like 3.7, in the 3.7 range. But the main reason that happened, and understanding what the CPI report is, as I told my wife, I said, man, I'm happy rates came back down. It's time to start getting out and sharing the news with people that, there's been so much fear put into our industry, like, well, rates are going to 10%, property values are going to fall. It's been a lot of fear pillaging, I would say, right? And I've been in this long enough that the same thing happened 2008. Well, 2008 values did fall a lot, right? So people still have that pain thinking every market is going to respond that way. CPI is what we're talking about, why the market increase got better, really takes categories of things, I'll call them household products, or things that consumers buy, right? Houses, cars, boats.
It's actually a basket. The term that the Bureau of Labor Statistics uses, and that's actually where that report comes from. They use the term a basket of goods. So there's about 250 different items that they basically, it's like supermarket sweep. They pretend if they were going to put all these items into a basket, how much are those items going to cost this month over last month, or this year over last year? So like you said, there's housing, there's energy, there's all kinds of different goods. And what happened at this CPI inflation report last week?
I mean, so we've been on a steady inflationary course that showed massive inflation, right? I mean, we've been experiencing it with, used cars were like almost 28% of like year over year, showing these numbers. Everything's getting more expensive. And finally, what they're starting to see with this most recent CPI report is prices are starting to come down a little, right? We're starting to see some stability. They're still basing that number a lot of times over an average. So even though that average went down, wouldn't it go down, Hammer, 2%? It was expected.
It was actually still up. This is where it gets confusing to a lot of people. It was actually still up, and inflation was up 0.3% over last month, October over September. However, being up, and this was, by the way, this is what we call core CPI, core inflation, which is without energy and housing costs, because that's what the ones that are figured the most stable. So the idea was we were up 0.3, but we thought we were going to be up 0.5. The previous month we had already been up 0.6. So 0.3 being significantly less than 0.6 is why inflation's still a problem, but less of a problem than the month before.
Right. We're starting to see things settle down. We're starting to see prices on a lot of things that really come into play for, in my opinion, two reasons, right? We've had supply chain issues, which caused a lot of it, are finally catching up. On top of that, with the Feds, with their policy and raising rates where they have, we've noticed, as we talked about, and what this is about a rate recap. We're talking about interest rates. Rates have went up. Well, things get the same $300,000 house costs, $300, $400 more with rates higher. It takes less buyers for that. Prices start to come down. That's their whole goal with raising these rates, is to be able to curb or to slow down this inflation. So when they saw that it's actually working, the markets responded to that. And so, hey, this is great news, better than expected. as far as what they were expecting the inflation report to be compared to what came out to. The markets responded positively. We saw a massive, one of the biggest ones I've seen in a day. We've seen it go the other way a couple times recently, that big, but to see the rates improve by that much in a single day is first time we've seen that, if I'm not mistaken, in almost 20 years.
Yeah, it was most. So just a reminder for those of you that have seen it before and for those that may not have, the reason that we see mortgage rates change, their rates are actually based on the bond market. So there's something specific called mortgage-backed securities, and I'm going to show you this fancy little chart in a minute. And those are a mortgage-backed security chart. And the better or worse that those mortgage-backed securities are performing, the better or worse rates are. So what Tom is talking about is every day we see a green candlestick, and each one of these lines is called a candlestick. In this chart right here, each one of these lines is a candlestick. And the reason they call it that is because at the top, you'll notice there's a little wick, just like a candle. And if you see a part at the bottom, they call that the tail. So the thin part at the bottom is the lowest point that the bond sold for that day. And the highest part is the thin part for the wick. The body is the fat part in the middle. Now, if the body is red, that means that we started out higher and they sold for lower. And when bonds sell for lower, that's bad for rates. When we see them start lower and sell for higher, that's good for rates. And what everyone can see, the longer we draw this chart out for, and let's say we draw it out for 6 months here, you can see that we had this very large green candle right here, just this huge improvement.
Oh, it's a beautiful candlestick.
It sure is, right? We were all loving that candlestick. And so normally you see about the size of the candles, and we see overall trends. So we could see, like, for example, right over here is July. When you guys see my mouse hovering, this is July. And then down over here is October. And we saw that the trend, these went down over time. They kept getting lower and lower. That's why you saw mortgage rates creep higher and higher as these bonds went lower and lower. Well, now we've seen a big rebound, and we saw most of that come last Thursday when we got that CPI inflation data. And part of the reason, by the way, that we saw that, it was not just the CPI inflation data. It was the week before we had a Fed meeting. And at that meeting, I thought we were going to see more improvement than we did. The Fed said, hey, we're going to slow down raising rates in the future. And I've shared with you guys a chart, and we call these Fed futures. This is what is expected for the Fed to raise rates as we head into the next meeting. So the expectation was that the Fed was going to raise rates in a slower pace at their December meeting, their February meeting, their March meeting. But what Fed Chair Jerome Powell said in his press conference was that their terminal rate, meaning the peak that they were going to stop raising rates at, was expected to be higher. And we were thinking that was going to be 5% or maybe 5.25%, as the belief by the markets, by traders, that the Fed would not have to raise rates as aggressively, and they won't hit that peak. And that's why the CPI data came in and said, hey, if inflation is already getting under control, the Fed won't have to be as aggressive, and they can ease back on raising rates as high, and we won't see as much of a peak as we expected. Because of that, that's why we saw such a strong reaction in bonds, why we saw things improve. And Tom, you mentioned that 10-year Treasury yield, and I'm going to go ahead and make this chart nice and big so we can show everybody. Let's see if actually I might have to refresh it so it'll move properly here. Let's see. And you said we saw that 10-year Treasury yield. I think we were up over 4.25, and then it dropped down to, like you said, in the 3.8s actually. And since then, since last Thursday, here we go. Now we've got it where we want it. Make it a little smaller. Since last Thursday, we've actually seen where this 10-year Treasury yield fell below this red line. So for those of you that are looking at this red line is a 50-day moving average, and it's what's called a technical resistance level. So we normally don't see we see these levels hold, and if we see improvement past them as we see these green candlesticks come down, that's actually a really good sign that there's room for mortgage bonds to follow, and that we could see them improve as well. So what that's done is we've seen a very dramatic improvement in mortgage rates over last week. Tom, do you think we'll see rates improve from here at all?
Purely speculatory, right? I mean, my opinion is no. I really don't. I think we've got a short-term reprieve. And, from everything that I'm hearing what the Feds are planning on doing, everything with them is, in my opinion, is reactionary. instead of looking ahead and say, man, let's look 12 months, 24 months ahead. What does us raising rates this high do? But not to get political, but they don't look at things that way. It's right now. So we still have, because they're looking, as you mentioned, and we 0.3 is what inflation came in at. Well, an average of what they're always looking at is an average of 2%. Would you say 3%?
Yeah, they want to see a 2%
is the normal market.
Right.
We're still at a rolling average a year over year at what, 6.8?
Yeah.
So I think until that average actually gets where they, what they view as a normal rate of inflation, I don't see them really continuing to lower rates. I think a lot of what we saw by that report is the markets normally already have built in the expected, like you showed, and I love how I always watch your videos anyway, so it's fun to actually be on it, but showing, what is the Fed's plans with raising rates? They always lay it out and say, here's our plan. Coming in December, we're going to raise it another quarter. We may, as he talked about, we may actually raise it more in January. So the markets already have that built into it. So when you start to see the response that we did, it's really them probably waiting for 2 more rate hikes, and we finally came back to be where that's at. But truthfully, the one thing that I always say to even all of my clients and borrowers, there's never you can never time it perfect. The fact is, you're either going to be paying rent, which is 100% interest, or you're building equity, which is proven to build generational wealth by 40 times what somebody who doesn't own a home, right? So pay your mortgage or pay someone else's. Rates are always going to fluctuate. Helmer kicked it off at the beginning and said, hey, rates went down. Check with your mortgage professional and see what they have a float down option, right? Most of all of my clients within the last week, we took advantage of that, right? It's a great value add to where I'm trying to look out for them, make sure that they have the best financing in place. If the market gets better again, man, we might be looking again, right? I mean, I hope that happens, although I don't think that's going to happen, in my opinion. But
yeah,
you're the expert. I'd love to hear your thoughts on it.
Thanks for the softball. On the near term, let's take a look. And basically, I like to look at windows of when am I going to be closing? If you're a consumer and you're closing on your home, if you're closing over the next couple of weeks, it's not a bad idea to take the rates as you see them right now, because these are exceptional rates compared to where we were just a week ago. So we don't want to necessarily risk losing them. We're not at risk to lose them that much. We've seen rates hold at this level for the last couple of days. So we saw a great improvement Thursday. Friday was Veterans Day. Maybe some of you veterans have heard of that day. And of course, thank you, for your service, for all of you that are watching and our members. So, but Friday, the markets were closed. And then on Monday, we were concerned that we were going to see maybe rates creep up or lose a lot of the gains that we saw. And we actually saw them hold pretty steady. They did give up a little bit, but it wasn't much. Tuesday, things improved again. This morning, things improved again a little bit. So we're still, for VA rates, you're going to find they're generally in those low 6s area. If you're not getting a VA loan for some reason and you're getting what we call conventional financing, that might be in the higher 6s, maybe 6.5 to 6 3/4, depending on your credit score and how much you're putting down. But over the next, we've got Thanksgiving week next week, which is going to be a very quiet week for the markets. They're of course closed on Thanksgiving. They are open on Friday for about a half a day for the bond market, but most lenders are closed. So what happens is rates are generally not likely to move much from between now and Thanksgiving. And once we get past those next couple of weeks, we may see rates improve a little bit more, probably not dramatic. And I said this even before the CPI data, though, I said, we're probably not likely to see rates come down much, even if that data comes in good. And it was a surprise. I wasn't the only one that was feeling that way. It was kind of, a lot of talking heads have said it was like a pressure release, because markets have been looking for a reason to improve. Stocks improved tremendously when that inflation data came out. Bonds, grabbed onto the coattails and improved at the same time. So we could see a little bit of improvement for those of you that may be closing later in November or into December. Now, if you are looking at closing outside of 30 days from now, after that December meeting, we've got the December Fed meeting on December 14th, which is when they're going to come out with their next Fed policy statement and the next press conference. And on December 13th, we're going to get the next CPI report. So if you have 30 or 45 days, if you just went under contract to buy a house, or if you're out there looking, we may see another window where things improve. Now, will we see another half a point rate jump like we did? Probably not. That was very unusual. It was the largest move since one source, Mortgage News Daily, and MBS Live, they talked about they've been tracking since 2009, and it was the largest improvement since then. And going back, you've been in the business since the early 2000s. I've been in the industry since the early 2000s. Definitely the biggest move that I can remember, seeing a half a point in one day like that to improve.
Yeah, it was. I mean, for me, we always talk about, the float down options, but rarely does it happen. Right.
Yeah. Rarely does that kick in.
A little bit here. You might get 1/8 of a percentage, but rarely do you see the market move in that drastic. Right. It creates a lot of instability for, creative. And that's how our market's been for a while. But it's interesting hearing with the CPI coming out the day before the Fed meeting. Fed already said they're going to raise the rates for December. It wasn't left for decision of, we may or we may not. They're going to raise it, right? But I think the market already has that built in. So,
it does. With right now, we're factoring in a half a point rate hike. Because right now we're at 3.75 for the Fed funds rate. They're 85% on Fed futures. It's an 85% probability that we're going to see a half a point rate hike and to bring it up to 4.25. There's still some outliers betting on 4.5, which means a 3/4 point rate hike. That's what the Fed's done the last 4 or 5 meetings, but it's unlikely that we would see that. Now, if that CPI data came in weak, then we would see a big jump over here. We would see expectation that the Fed would have to be more aggressive. That would be bad for mortgage rates. But if that CPI data comes in, when I say weak, I mean if it comes in not helping us, if it comes in showing that inflation has slowed down again, then we will see more expectation that the Fed, everything that they've already done is working, starting to take effect. And then markets will price in that the Fed can slow down, maybe not see a Fed peak of 4.75, maybe 4.5. So they'll start to price that in. And that's why we could see a little bit of further improvement about a month from now, depending on what that data comes in at. So awesome. Well, Tom, I mean, is there anything else you want to leave everybody with as far as, what it's like to buy a home in your market, or why now is a good time to buy a house, or anything else you'd like to talk about?
I think we covered it. I mean, if you're paying rent, now's the time to buy a house if you're planning on being there for 3 to 5 years, right? I think with a lot of our veterans, there's always the uncertainty of, they may be PCSing, they may be, looking at retirement orders here before too long. There's a lot of situations, and everybody's situation's different. What I would say, the piece of advice I would give, utilize the pros that are in this group. We have pros that work at banks. We have pros that work at brokerages. All of these people have went through stringent testing to make sure that they are looking out for you in your best interest, right? We're never going to reach out to you and say, hey, I heard Helmer said rates are at low 6s. Well, I just got somebody at 5.9. Well, there's a lot of noise. What Chris, Nathan, Brandy, the team at Vetted VA has done is to make sure that you have a source, just like Helmer, to come in and give you truthful information. Everybody's situation's different, though. It's not, that's why they don't just publish one interest rate and, okay, hey, you've got this rate. Work with a professional that's vetted, that understands the scenarios, that understands the VA loan, that's an expert, and most importantly, that's held accountable, right? That's one of the things that I love about this group. I use it as a referral network for myself in any state that I have clients that aren't licensed. If I have a client looking to buy in Idaho, I don't know, somewhere that I'm not licensed in, well, I always look for this group for a point of reference of expert advice and people that you can trust. So other than that, I don't have anything else other than it was just Veterans Day. So thank you all the veterans who did serve and give your time and the risk that took in your life to help support, keep the freedom that we have. So I appreciate that. And I appreciate being on this today. I learned something again, and I'm hoping you know, I'm hoping that rates get better though and continue to. Although, you know,
they will.
it's still a great time though. Even right now, I don't think we're going to see that housing crash. Those that are concerned that we're going to see a 20% price reduction, that's just not realistic. You know, the people that have qualified for homes right now, that's why you're not seeing many houses come to market, because a lot of people have just wicked good interest rates and they can afford it. Our housing affordability is there. So, you know, I don't think we're going to see that. If you're sitting on the sidelines and you're really just not sure of the numbers, take that leap of faith and reach out and have a conversation with one of us and let us just try to put those numbers into perspective. The good part is now you can get seller paid closing costs in a lot of markets, where before, now on a VA loan, it was tough to get seller paid closing costs, right? Especially in the Minnesota market here, Wisconsin, a lot of the Midwest region. I really say everywhere. The market was highly competitive. And right now, almost every purchase agreement I've had come across my desk this week has seller paid closing costs. So, you know, that's one of the questions everybody asks. I thought I could finance closing costs. Well, you know, in a sense you can, but you have to ask the seller to, you know, pay for it. If you're paying $100,000 and now you need $3,000 in closing costs, you're paying $103,000. So, but now is still a great time. Just depends on your situation. So thank you, Helmer. I appreciate you having me on here today.
Thanks, Tom. Thanks for joining us. Remember, everybody, you can join us each week to discuss this, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. I believe we will be on next week. At least I'll be working on Wednesday. So unless Chris or Nathan doesn't want to have it for some reason, I will be here for you all, and we'll see you next Wednesday. Take care, everybody.